The first question is clearly explain the terms currency strengthening, appreciation, and currency weakening, depreciation. Provide a realistic scenario using RM and Australian dollar for each case. First, we must explain about the currency strengthening, appreciation. Appreciation occurs when the value of a country increases relative to another currency. This means you can get more of the other currency with the same amount of your currency. For example, RM appreciates against Australian dollar. Let's say 1 Australian dollar equal to RM 3 ringgit and 20 cent today. Later in the next day, the exchange rate changes to the 1 Australian dollar equal to RM 3 ringgit. This means the ringgit Malaysia RM has appreciated by 20 cent because now you need fewer RM to buy 1 Australian dollar. For the realistic situation, Malaysia's export like palm oil become more competitive and in high demand in Australia. Australian buyers need to convert Australian dollar to ringgit Malaysia to pay Malaysian exporters. This will increasing demand for RM. As a result, the RM appreciated. Next, I will explain about the currency weakening, which mean depreciation. Depreciation occurs when the value of a country's currency decreases relative to the another currency. This means you need more of your currency to get the same amount of the other currency. For example, RM depreciates against Australian dollar. Initially, 1 Australian dollar equal to RM 3 ringgit and 20 cent. Later, the exchange rate changes to the 1 Australian dollar equal to RM 3 ringgit and 50 cent. This means the ringgit Malaysia has depreciated because now you need more ringgit Malaysia to buy 1 Australian dollar. For the realistic situation, suppose Malaysia experience political uncertainty or rising inflation, investors may lose confidence and sell off the RM assets, reducing demand for RM. This lead to the RM weakening against foreign currencies like Australian dollar. For the second question is, what is the fundamental distinctions in the economic insight provided by a nominal exchange rate compared to a real exchange rate? Illustrate with a clear RM per USD example of how Malaysia's real exchange rate could depreciate, making it is good relatively cheaper internationally, even if it is nominal exchange rate against the US dollar remains stable or experience a slight appreciation due to the differing inflation rates. Firstly, I will explain about the nominal exchange rate. The nominal exchange rate is the price of one currency in terms of another without adjusting for inflation. For the real exchange rate is adjust for inflation differences between two countries. It measures how much foreign goods can be exchanged for domestic goods. This means that the real exchange rates reflect the real purchasing power of a currency in terms of goods and services of a country. The formula we can use to calculate is the exchange rate equal to nominal exchange rates multiplied with foreign price level CPI star divided by domestic price level CPI. For example, nominal exchange rate is 4 ringgit and 50 cents per USD. CPI star is US 125 with the inflation rates 25%. CPI is from Malaysia 110 with the inflation rates 10%. We calculate by real exchange rate equal to 4 ringgit and 50 cents times with 125 CPI from US divided by 110 by the CPI from the Malaysia. We got the value is RM 5 ringgit and 11 cents per US dollar. The explanation is RM in real exchange rate depreciates to RM 5 ringgit and 11 cents per US dollar compared to nominal exchange rates RM 4 ringgit and 50 cents per US dollar. Although the nominal exchange rate has not changed, the price of goods and services in Malaysia has increased faster than in the US. Therefore, the relative price of Malaysian goods and services is cheaper internationally. This has led to depreciation of the RM against the US dollar. In addition, the RM has become undervalued and has causes import cost to increase. For the third question is clearly distinguish between the spot market and the forward market for foreign exchange based on their operational characteristic and typical use cases. Provide a specific example of how Malaysian manufacturing company planning to import essential machinery from the US in 3 months might utilize the forward market for RM per USD. Explain why this company might prefer the forward market over waiting to use the spot market at the time of payment. For the spot market is the currency exchange happen right away. Next, immediate payment for trade, investment, remittance and arbitrage. Third, spot exchange rate and the market rate today. Credit risk is minimal because settlement is near immediate. For the forward market, delivery occurs on the future date specified in the contract like 1, 3 and 6 months. Next, hedging non-future cash flow and also used for speculation and arbitrage. Forward exchange rate agree today for future settlements incorporates interest rate differentials. For the credit risk present, because counterparties remain exposed until the future dates. For example, Touchmax Sendirian Berhad, a Malaysian manufacturer company importing US-made machinery costing $2 million. Payment due 3 months from today. Current spot rate is $1 equal to RM 4 ringgit and 45 cents. 3 month forward is $1 equal to RM 4 ringgit and 48 cents. Today, Touchmax signed a buy $2 million 3 months forward at RM 4 ringgit and 48 cents. No immediate cash outlay apart from any small bank margin or credit line wages. Credit line usage in 3 month maturity, regardless of the then prevailing spot rate, Touchmax receive $2 million from the bank and pay RM 8 ringgit and 96 million that can get from the calculate 2 million times with RM 4 ringgit and 48 cents. The $, payment remitted to the US supplier on schedule. The company prefer the forward market because of eliminate exchange rate uncertainty. If the rate unexpectedly depreciate, for example, spot move to RM 4 ringgit and 70 cents, Touchmax machinery cost would jump to RM 9 ringgit and 40 cents million in the spot market. The forward lock-in caps the cost at RM 8 ringgit and 96 million, protecting margins. The company wants avoid adverse market timing. Waiting for 3 months and then using the spot market is a speculative gamble on RM per $. Forward using turns to unknown into the non-cost. A currency option could also hedge risk but would require an option premium. For the question number 4, given the data below, determine the real exchange rate between RM and Japanese yen in both the initial and final period. Discuss how the result reflect Malaysia's trade competitiveness with Japan. Refer to the table the data has given. We can calculate using the formula real exchange rate equal to the nominal exchange rates multiply with the CPI star divided with CPI. Firstly, we calculate initial periods. RM 3 ringgit and 80 cents from the nominal exchange rate RM per 100 Japanese yen times with 100 divided by 105 from the Malaysia CPI in initial period. We got the value is RM 3 ringgit and 62 cents per 100 Japanese yen. Next, we calculate the final periods. We calculate by RM 3 ringgit and 60 cents times with 102 from the Japanese CPI divided with 110. We got the value is RM 3 ringgit and 34 cents per 100 Japanese yen. The explanation is the real exchange rates Malaysia appreciate from RM 3 ringgit and 62 cents per 100 Japanese yen to RM 3 ringgit and 34 cents per 100 Japanese yen. A real depreciation makes Malaysians goods and services relatively expensive compared to Japanese goods and services. For trade competitiveness, Malaysia's import from Japan become more attractive, potentially increasing demand for Japanese products. Japanese import become relatively more cheaper in Malaysia. Malaysia will facing deficit balance of trade because Malaysian imports more than export. The question number 6 is, suppose a Malaysian investor considers investing RM150,000 either in the UK at 3.2% or in Malaysia at 2%. Current exchange rate is RM5.50 per GBP and expected to become RM5.30 per GBP. Calculate the final RM return in both cases and suggest the better option. First, we calculate the Malaysia. 1 plus 0.02. 0.02 we got from the 2% times with 100%. Then the value we got is 1.02. Then RM 150,000 times with 1.02, we got the value for Malaysia is 153,000. Next, we calculate for the UK. 1 plus 0.032. 0.032 we got from 3.2%. Times with 100%, then we got 1.32. Next, we convert to GBP using the current exchange rate. 150,000 divided by RM 5.50, we got the value is GBP 27.72 cent. After 1 year, GBP 272 and 73 cents times with 1.032. We got the value is GBP 28,145.46 cents. Lastly, we convert to RM using expected exchange rate. GBP 28,145.46 cents times with RM 5 ringgit and 30 cents. We got the final value is RM 149,170.94 cents. The explanation is, even though the interest rate is higher in UK, which is 3.2%, but pound is expected to depreciate from RM 5 ringgit and 50 cent per GBP to RM 5 ringgit and 30 cents per GBP. Invest in Malaysia is more better because the investor will get profit RM 3,000. The 3,000 we can get by calculate RM 153,000 minus with 150,000. Then we got the profit RM 3,000. The question number 7 is, explain what it means to hold a long VC short forward position in the context of foreign exchange contracts. Give example involving RM per GBP British pound. First, I explain about the forward contract. Forward contract is an agreement to sell or buy a foreign currency at fixed exchange rate on future date and to protect against currency risk. Long forward position. Long forward position is where we agree to buy a foreign currency in future because we expected that foreign currency will appreciate in future. For example, a Malaysian importer of UK goods expect to make a payment of GBP 100,000 in 3 months. They concern if GBP strengthen, it will cost more RM to buy the pound later. The solution is they enter a long forward contract to buy GBP 100,000 at a fixed RM per GBP rate today like RM 5 ringgit and 55 cents for delivery in 3 months. The importer log in the future cost in RM, avoiding currency risk. Next, for the short forward position. Short forward position is where we agree to sell foreign currency in the future because we expected that foreign currency will depreciate. For the long, we can say the keyword is to buy a foreign currency, but for short is to sell a foreign currency. For example, for short forward position, a Malaysian exporter to the UK expect to receive GBP 100,000 in 3 months. They concern if GBP weakens, converting it back to ringgit Malaysia later will yield fewer ringgit Malaysia. The solution is they enter a short forward contract to sell GBP 100,000 at fixed RM per GBP rate today, like RM 5 ringgit and 55 cents for delivery in 3 months. The exporter log in the ringgit Malaysia revenue, protecting profit margins. The question number 8. The spot rate is RM 3 ringgit per Australian dollar. and the 9-month forward rate is RM 3 ringgit and 5 cents. Calculate the annualized forward premium or discount. State whether RM is trading at a premium or discount. We can calculate by using the formula is for F minus with S divided with S. F is a forward rate, S is a spot rate. Next, we multiply with 12. 12 is in 1 year, which is 12 months, divided with N. N is the how many months that the forward rate. Okay, we can using the value, we combine with the formula 3 ringgit and 5 cents minus with RM 3 ringgit, the spot rate. We divided with 3 ringgit also, that's it, the spot rate. Multiply with 12 months, divided with 9 months from the forward rates. Then we times with 100. We got value is 2.22%, which is mean that this forward premium. Australian dollar trades at 2.22%. Annualized premium and expected to appreciate against ringgit Malaysia, while RM trades a discount against the Australian dollar and expected to depreciates. From the conclusion, we can say that the forward rate is more than the spot rate. The question number 11 is a Malaysian exporter is to receive euro 100,000 in 6 months. The forward rate is RM 5 ringgit and 8 cents per euro, while the expected spot rate then is RM 5 ringgit and 20 cents per euro. Calculate and compare the RM, proceed under both scenarios and determine if locking in a forward contract was beneficial. First of all, we calculate the forward rate, euro 100,000 times with RM 5 ringgit 0.8 cents per euro. The value we got is RM 508,000 for the forward rate. Next, we calculate the spot rate, euro 100,000 multiply with RM 5 ringgit and 20 cents per euro. The value we got is RM 520,000. The explanation is Malaysian exporter need to wait until 6 months, then use spot rate. They will earn benefits by RM 12,000. The value RM 12,000 we can calculate by the RM 520,000 from the spot rate minus with RM 508,000 from the forward rate. Then there we get the benefit if they use the spot rate, which means we can conclude that spot rate is more than the forward rate. If they use the forward contract, they will get a loss by deficit RM 12,000. Like we can calculate by vice versa. We vice versa from the forward rate minus with the spot rate. For the question number 13, define clearly absolute purchasing power parity and relative purchasing power parity. Highlight the main differences between the two. For the absolute purchasing power parity, identical goods should have the same price in different countries when converted to a common currency, ignoring trade barriers and transportation costs. For relative purchasing power parity, focus on changes in exchange rate over time, linking them to differences in inflation rates between two countries. Absolute purchasing power parity formula, S equal to P divided by P star, where S is exchange rate domestic currency per foreign currency. P is for domestic price level, P star is foreign price level. For the relative purchasing power parity, the formula is percent different S equal to pi domestic minus with pi foreign, where is percent different S is for percentage changes in the exchange rate. Pi domestic is for domestic inflation rate. Pi foreign is the foreign inflation rate. We can say the interpretation, if the inflation rate domestic is more than inflation rate foreign, which means domestic currency depreciates. If the inflation rate domestic lower than inflation rate foreign inflation rate, which means domestic currency appreciated. For the absolute purchasing power parity, have an arbitrage effect. The firstly, increased demand for cheaper goods. Second is increased supply in expensive markets. And also, absolute purchasing power parity have a limitation. Firstly, non-tradable goods services like haircut cannot be arbitraged. Second, different consumption baskets. Countries consume different goods. And lastly, transport cost or tariff. Ignore in theory but significance in practice. For the relative purchasing power parity, only have a limitation. Firstly, short-term factors, interest rate, speculation and capital flows disrupt purchasing power parity. Second, non-tradable goods services like healthcare are not arbitrage. Lastly, trade barrier, tariff and quotas distort price comparisons. For the question number 16, a laptop is sold for RM4,500 in Malaysia and $1,000 in the US. The market exchange rate is RM4.60 per US dollar. Test if absolute purchasing power parity is valid based on this data. We must calculate using the formula S equal to P divided by P star. We combine the value in the formula. RM4,500 divided by US dollar 1,000. We got the value is RM4.50 per US dollar. The explanation is for this case, absolute purchasing power parity does not hold. Laptop in Malaysia is cheaper compared to the US. Price of laptop in Malaysia is RM4.50 per US dollar, while the price of laptop in the US is RM4.60 per US dollar, which is US dollar 1,000 times with RM4.60 per US dollar. We got the value is RM4,600. For this case, there is arbitrage opportunity where Malaysian will buy laptop in Malaysia RM4,500 and sell to US RM4,600. Malaysian will convert the yield to RM using exchange rate RM4.60 per US dollar. Malaysian consumer will earn benefit by RM100. The benefit we can calculate by RM4,600 minus with RM4,500. We got the value is RM100 for the benefit that Malaysian consumer earn. The question number 70 is a book costs £40 in the UK and $60 in the US. If the current exchange rate is £1 equal to $1.40, explain whether arbitrage opportunities exist based on the absolute purchasing power parity. Calculate the no-arbitrage exchange rate. Firstly, we must use the formula S equal to P divided by P star. We can calculate by $60 divided with £40. The value we got is $1.50 per British pound. The explanation is arbitrage opportunities exist. Absolute purchasing power parity is not equal to current exchange rates, which is no arbitrage because exchange rate is because exchange rate is $1.50 per GBP and the current exchange rate is $1.40 per GBP. For example, price of book in UK is more cheaper than US. Price of book in UK is £40 times with $1.40 per GBP equal to we can get the value is $56. US people will buy book at UK then convert that price using market exchange rate. US people can save $4 compare when they buy in US with $60. Saving is $60 minus with $56. We can get the value is $4 for the saving. Next, the question number 20. A jacket costs CHF 100 in Switzerland and $90 in the US. If the current exchange rate is CHF 1 equal to the 85 cent dollar, access is arbitrage exists. What should the exchange rate be to eliminate the opportunity? Firstly, we using the formula S equal to P divided by P star. We combine the value with the formula. We can calculate that $90 divided by divided by CHF 100, we got the value is 0.9 USD per CHF. The explanation is, for this case, arbitrage is this. Absolute purchasing power parity rate is bigger than the current exchange rate. Price of jacket in US is expensive, which is $90, while the price of jacket in Switzerland is cheaper, which is $85. CHF 100 times with 0.85 cents US dollar per CHF, we got the value is $85. US people will buy jacket at Switzerland and then convert to USD. People will save by $5. We can calculate by $90 minus with $85. We got the value $5 for the saving. The current exchange rate should be increases to 0.90 cent US dollar per CHF if want to eliminate the opportunity. The question number 22, using the demand and supply concepts in the foreign exchange market, explain how the RM per Japanese yen exchange rate is determined. Include a label graph to support your explanation. Firstly, the RM per Japanese yen exchange rate is determined by the interaction, demands and supply in foreign exchange market. For the demand concept, if demand for Japanese yen increase, then the Japanese yen will appreciate. For example, Malaysian consumers want to buy Japanese goods. They need Japanese yen because demand of Japanese yen is increases. Japanese yen will appreciate because inflow more than outflow of Japanese yen. We can draw a graph that for demands. Based on the graph, we can interpret that the original point at A, where the exchange rates for RM per JPY at SA and quantity of Japanese yen demand at QA. Based on the example, if Malaysian consumers wants to buy Japanese goods, they need more Japanese, which means the demand of Japanese yen will increase. Point A on the demand curve, DJPY, will move to the rightward at the point B. Exchange rate RM per JPY decreases from SA to SB, indicates that RM has appreciated. The quantity of Japanese yen demanded increases and move from QA to QB. As a result, Malaysian consumers would increase their quantity of Japanese yen demanded in order to buy Japanese goods. For the supply concept, if supply for Japanese yen increase, then Japanese yen will become weaker because of outflow for Japanese yen is more than inflow of Japanese yen. For example, Japanese importer want to buy goods from Malaysia, so they need to supply Japanese yen in exchange for ringgit Malaysia. Supply of Japanese yen will increase, which means cash outflow of Japanese yen is more than cash inflow. Next, we draw a graph for the supply for the Japanese yen. The interpret is the original point at point A, where the exchange rate RM per JPY at S1 and the quantity of Japanese yen supply at Q1. Based on the example, Japanese importers want to buy goods from Malaysia. They need to supply Japanese in exchange for RM. Supply of Japanese yen will increase. Point on the supply curve SJPY will moving to the rightward from the A to the point B. The exchange rate RM per JPY increases from S1 to S2. RM has depreciated relative to the Japanese yen. The quantity of supply for Japanese yen increases and move from Q1 to Q2. As a result, Japanese consumers would increase their quantity of supply for Japanese yen in order to exchange for RM. For the question 24, given Malaysia's annual interest rate is 2.5%, UK annual interest rate is 4.5%, current spot exchange rate is RM5 ringgit and 30 cent per GBP, using uncovered interest parity, calculate the expected future spot exchange rate after 1 year. Firstly, we must use the formula R minus with R star equal to E minus S divided by S. Then we combine the value with the formula. For the left side, we must write 0.025 minus with 0.045. This value we got from the annual interest rate from both country, Malaysia and UK. Then we times with the 100%. Then we equal to E minus 5 ringgit and 30 cent divided by 5 ringgit and 30 cent. Next, we got the value from by the left side is negative 0.02 For the right side, we write the same equation from the above. Next, we continue with the negative 0.106 we got from the negative 0.02 times with RM 5 ringgit and 30 cents from the right side. Then we equal to E minus with the 5 ringgit and 30 cents. Next, we continue negative 0.106 plus with 5 ringgit and 30 cents equal to E. Then E we got RM 5 ringgit and 20 cent. The final value is RM 5 ringgit and 20 cent per GBP. The explanation is the expected future spot rate is RM 5 ringgit and 20 cent per GBP. This means that interest rate in Malaysia is lower than UK. RM is expected to appreciate against GBP from the RM 5 ringgit and 30 cent to RM 5 ringgit and 20 cent. For the question 27, derive the condition for real interest parity by integrating the Fisher equation, relative purchasing power parity and uncovered interest parity. Clearly explain each step and its economic implication. I follow the step by the doctor slide that given in the online learning. Step 1 is Fisher equation, domestic and foreign. R equal to R plus pi, which means domestic. R star equal to R star plus pi star, which means foreign, where the R and R star is nominal interest rate for the domestic and foreign, and R, small r and small r star is real interest rate for domestic and foreign also. Next, pi and pi star is for inflation rate, domestic and foreign. Step 2, relative purchasing power parity. We use the formula E bracket S1 minus with S0 divided by S0. Which means that pi minus with pi star. This related expected exchange rate change to inflation differential. Next, the step 3 is uncovered interest parity. The formula is E bracket S1 bracket minus S0 divided by S0, which means that R minus with R star. For the step 4 is combine the RPPP and UIP. Since both right hand sides are equal, R minus R star equal to pi minus pi star. Now we substitute the Fisher equation in both R and R star. As we can see, I already the substitute, then we got the value in the step 5. In step 5, derive real interest parity. Simplify that R small r minus with small r star equal to 0 or same to the R equal to R star. This is the real interest parity condition. Real interest rate are equal across countries.